Hi, this is Prashil, and you're listening to the Equity Masters Stock Market Wrap Up. In today's edition, I'll be taking you through what moved the markets over the week. So let's jump right in. The government's latest push for electric vehicles. Foreign portfolio investors are coming back. But are they really? India's GDP is slowing down, but India is still the fastest. GST cut on under construction flat. What exactly is the benefit? We'll take a look at this and more in this week's edition. Now, a quick look at the broader markets. Asian and European share markets were trading muted as pessimism surrounding the resolution to the US-China trade war grew further. Back home, Indian indices ended the week in green amid easing geopolitical tensions between India and Pakistan. With the markets out of the way, let's look at the key stories in focus today. The Union Cabinet announced a 100 billion rupees package for the second phase of the faster adoption and manufacturing of hybrid and electric vehicles, that is the FAME scheme. The scheme's first phase had an allocation of just under 9 billion rupees. The second phase of the scheme comes after a 2-year delay as it was expected in 2017 when the tenure of the first phase ended. As per the news, most of the funds in this package will be contributed to electric 2 and 3 vehicles and buses used for public transports. And e-rickshaw drivers can also avail of the subsidy provided in this scheme. Under this scheme, there will be a subsidy of up to 2.5 lakh rupees for 60,000 electric cars and a dole of around 20,000 rupees for 20,000 hybrid cars that are bought in the next 3 years. Through FAME, the government is looking to achieve 30% electric mobility by 2030. It will be interesting to see how the government aims to achieve this target. The auto industry is already facing regulatory headwinds. The shift from BS4 emission norms to BS6 has been 2 years ahead of schedule without an intermediate stage. The government, if it is serious about such ambitious targets, should offer the necessary infrastructural support and do its bit for a smoother transition. In another development, overseas flows into domestic equities this month were the highest in 12 months. So far this month, foreign portfolio investors have brought stocks worth 1.9 billion US dollars, the highest since March 2008, when they had pumped in over 2 billion US dollars. Since then, foreign flows have worsened. FPIs have taken out money in 7 out of 12 months. It is now being reported that the reversal in overseas flows this month will boost investor sentiment, which has been hit due to escalation between the cross-border tensions between India and Pakistan. However, the latest inflow tally needs to be taken with a pinch of salt. The market has seen single-day FPI investment of 1.7 billion US dollars, the highest in 4 years, and this was on account of a stake sale by Dutch bank ING in Kotak Mahindra Bank. So the high inflow tallies this month aren't necessarily due to a change in sentiment. Foreign portfolio investors continue to remain cautious, especially ahead of elections in the country. Moving on to news from the realty sector, the Goods and Services Tax Council reduced the GST rate on under construction houses. For flats priced more than 4.5 million rupees, the new GST rate applicable from 1st April 2019 stands at 5% as against the 12% earlier. The council also cut GST rates on affordable housing to 1% from the current 8%. In both cases, the builders will not be eligible to claim input tax credit in the new structure. Currently, GST is levied at an effective rate of 12%, which is a standard rate of 18% less a deduction of 6% as land value. And this is for normal housing. Coming to affordable housing, GST is charged at an effective rate of 8%, which has a concessional rate of 12% less a deduction of 4% as land value. Notably, GST is charged for under construction property or ready to move in flats where completion certificate has not been issued at the time of sale. According to reports, the GST Council will also look at issues such as transfer of development rights, joint development agreements, lease premium, sale and transfer of floor space index, among other issues. The stamp duty and registration and other charges remain as they are, and flats which have received completion certificates are out of the purview of GST. Moving on to news about the economy, India's GDP growth slipped to 6.6% in the third quarter of FY19. The economy had grown at 7.1% in the second quarter and 8.2% in the first quarter of the year. However, despite the slowdown in growth, India retained its fastest growing economy tag as China clocked in a GDP growth of 6.4% for the quarter. Now notably, India's core sector growth continued to go down for the third straight month in January as the two largest contributing sectors of electricity and refinery products remained in the negative zone. January 2019 saw growth in the 8 core sectors of the economy crash to a 19-month low at 1.8%, slipping below the 2.8% growth in December. Now it will be very interesting to see if India continues to retain its fastest growing economy tag, especially on the back of stagnating core sectors and a tough global environment. Well, that's all from us today. Before signing off, we would like to know if you like our podcast. Is there anything specific you'd like us to cover? We would love your feedback. Just visit equitymaster.com and drop us a line. We look forward to hearing from you. Thank you and happy investing.